Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. He's speaking to us from Alabama. Welcome back to the show.
Jim, thanks as always for having me.
Tim, we thought the market had peaked back in July. We had that major correction in August, and now we're setting new highs again. So where do we go from here after this rate cut by the Fed, just as you predicted?
Well, Jim, I did think, I had written for a while, back from the first of the year, that I thought we would go up into the third quarter, which we have. And I did think that it peaked in July. I did. We did an interview and said as much. Was very cautious about it and thought that it had peaked. Not to make excuses, but the behavior since then has been kind of odd, but here we are nonetheless. And I think that the process, I know that the process did begin in July, and yes, we're making another, or have made another push up. With this higher level setup that I'm looking at, this is going to be the third attempted downturn out of this long-term economic cycle. We've talked about that. The first attempted downturn was, the last economic cycle peaked with the 2000 dot-com bubble. The first attempted downturn, just as a bit of a review, the first attempted downturn out of the current long-term economic cycle occurred in 2007, and then the second attempted downturn occurred in 2020. And here we are. It's been a very slow process, but we're moving toward that setup for this third attempted downturn out of this the current long-term economic cycle. And part of that process is the rate cuts. And in 2000, with that top, equities peaked first, equities peaked first, and then they ahead of the rate cuts. In 2007 and 2020, the rate cuts, the market rallied on the news of the rate cuts. It rallied, for a little while after the rate cuts. In one instance, there was 2 cuts before the market peaked. In the other instance, and I don't remember which one was which, there were 3 cuts before the market peaked. It looked like in July that the market had peaked ahead of the rate cut. That was a pretty good decline. And the structure that was in place at the time, that's the way you had to call it. It's what it looked like. But now what we've seen with this additional push up is this is more akin to the 2007 and 2020 setup, where we've seen the market rally into the first cut. And I've had a lot of the talk I've heard has said that the Fed has waited too long. And granted, that was a long, what I could term a plateau period. The last hike was in July of 23. We ran over 400 days with rates just flatlined. And I knew that, based on the model, that it had, we were, had seen the peak, and that we're in that plateau period, if you will. But there's a process of events that has to happen with the Fed model I have. It's based on the T-bill rate and some rates of change, spreads, and different things. And as long as that plateau period had been, those things had not triggered. And so we finally got to the point the week before the Fed cut, the announcement. I wrote in my short-term updates that it had triggered and that we should see a half-point rate cut. And so that we did see, obviously, and this is all part of the process. But the point being is that this setup for this third attempted downturn, it is more like the one with that we saw, more like the setup that occurred in 2007 in 2020. So now what we have to see is, in my world, is I have to see the right structure fall in place, to cap equities. I think commodities have peaked. That's a piece of it. Rates, we've rounded the curve there. That's a piece of it. And then the final piece, I think, is to get the structure to cap this market. And there are some major intermediate and slightly longer term cycles that are coming due. And so I think we're in a danger zone where we could see this thing start to set up again. When I say set up, I'm talking about specific to equities, and a turn try to take hold again, and then we just have to see how it materializes from there. That's pretty much where we are.
When do you think the Fed is going to cut, or are they going to cut?
Again, you mean?
Yes.
Based on the model that I see, I think a rate cut is probably closer than people realize, but it's based on, I can't give an answer and say they're going to cut on a certain date, because that's foolish. There's a model, just like with this, for this last rate cut, I have to see all the pieces, parts fall in place. And we're actually getting close. We're not there yet, but I would say if the 3-month T-bill fell somewhere between another quarter and a half, they're going to be cutting. So it's the pressure is on rates. I think it was back in my July research letter, I did a pretty extensive analysis of rates showing where they should go and why, and mathematically. And there's no question. I've had no question in my mind that rates were going lower, and that is not a positive thing for the economy, contrary to popular belief. In fact, for anyone that's new listener, this entire rate hiking cycle coming out of the 2021 low, I've proven that the whole damn thing was fabricated as part of the reinflation effort of this sixth long-term economic cycle. And anyway, I digress a little bit on that, but that has run its course, and we're in the process of seeing the setup for this downturn out of this the current long-term economic cycle, the third attempted downturn, that is.
Now, market historian Bob Hoy has pointed out the Fed was created to prevent recessions and depressions, and there's been 18 recessions since it was invented. Is the Fed a useful critter from Jekyll Island, or is it something that should be scrapped and just sit with a Treasury board?
Well, I think it should sit with a Treasury board. I think that the Fed, obviously it's a powerful entity, and I used to be of the opinion, like a lot of people are, that the Fed, they're just a bunch of buffoons and they can't operate in the real world. And as one guy I know used to say, they couldn't run a popsicle stand. But that is absolutely not true. The Fed is an extremely powerful and talented bunch of individuals. I'm not saying I agree with what they do. I think that they are the reason we are where we are. They have created this bubble. And one of the things I've covered in recent letters is, and Richard Russell used to say a long, long time ago, he coined the phrase, as far as I know, that inflate or die. And in this debt-based monetary system that we all live, the Fed is there to keep that system going, in my opinion. I've proven that every time there's any kind of little financial hiccup, they step on the gas. They know exactly when to do it, and they're masters at it. One example, when we were trying to deflate after the 2020 top and the COVID nonsense that from my perspective, looking at it from a financial end, that was a cover story at minimum, used to let some air out of the bubble. In 2021, the setup out of this long-term economic cycle was trying, again, I remind you, the attempt number 2 for this downturn out of this long-term economic cycle was with the 2020 top. It had begun trying to set up again in the spring, in February, March of 2021. That's when all of the stuff happened, and people may not remember. I remember because I was watching it in awe. And that is precisely when all of the supply chain issues were kicked off. That is precisely when the Fed started doing the reverse repo operations. That's when they started talking about the inflation. That they jawbone the market into believing it, because everybody knows you don't fight the Fed. You don't fight the Fed, and so if the Fed was, they were jawboning inflation, higher rates, and they created that, like I said, that entire rate hiking cycle as part of the save job. Well, now, the market bought that as long as the market bought it, but now it's reached I guess you'd call it the point of saturation. It's run its course, and they can't bullshit the market anymore. So now we're at a point where we're seeing the downturn out of the peaking of that fabricated, whatever you want to call it, save job with this rate hiking cycle. We've rounded that curve. We're rolling over out of that. And so now the market is in control. And I say the market, interest rates, and interest rates, the short-term rates trump them and force them to cut. They conned the market into higher rates in 21, but now the market's in control and it's dictating lower rates. So I don't know if I answered the question or not, but is the Fed, yes, they are a very powerful entity, but and I don't agree with what they've done, because they have put us in this position trying to save the debt-based system, because it has to inflate. You have to have constant inflation. And if you just think about it, what happened with the dot-com bubble? Things were trying to deflate. And what do? They step in with their stimulus, and they created the entire sixth economic cycle with this stimulus. That's when it really got to be obvious. And then in 07, what happened? It tried to deflate. What happened to the price of houses? What happened to the price of oil? What happened to the real estate prices? Equity prices. Deflate. And what do? They come in and they do their stimulus. And then they push it into the 2020 top. And what happened? It tried to deflate. And then what do? We see the largest stimulus spending in history. And where are we now? $35+ trillion. And so they are fighting the deflation that is trying to take hold. In way back in, I think it was 2014 or 15, Christine Lagarde talked about deflation, and she said it's something to the effect, as if I can remember her quote, she said, if inflation is the genie, then deflation is the ogre, or the ogre is the deflation, or whatever, something to that effect. You get it. But so they know that deflation is the enemy, and that is what the Fed is there to do, is to keep the bubble going and bullshit everybody else in the process of what they're doing.
So how does this all end, Tim?
Collapse.
And what's that going to look like? What's going to be the first hint that the cart's about to tip into the abyss?
Well, we've been there, like I said, several times. We were there in 07, and they were able to save it, and nobody really realized the potential of it. We were there in 2020, and nobody really realized the potential of it. Everybody was focused on COVID. We were there in 01, and nobody realized it because nobody realized it. They're not, they didn't realize the magnitude, the danger of what was happening with, this long-term cycle that I'm monitoring trying to roll over. And now here we are, we're in another position where it's trying to roll over. And it boils down to this: can they save it again? I don't know. I don't think they know. I think they do the best job they can at trying to save it, but you can't deny the facts. It tried to collapse in 2000. That was the organic top of the market. That's when we saw a lot of things: job participation rate, some of the monetary money figures, growth of M2. Lots of things peaked in conjunction with that top. That was a more organic, even though it was Fed-driven, ultimately it always is, but that was an organic top. And everything we've done since then has been designed to try to save the system. And if you just stand back and think about it, what happens every time it tries to collapse? That's deflation. What does the Fed do? They come in and reinflate. So and I'm telling you, we're at another juncture here. I think the election is going to be a pivotal point, regardless of the outcome. And I think we face some treacherous times. Yes, it tried to start setting up in July, and we've had this one more push, and it turned out, like I said, I'm repeating myself, but to be clear, rather than that setup happening like the 2000 top and that downturn out of the fifth long-term economic cycle, we're seeing now with this additional push a setup more like 07 and 2020, where equities are making that one last push as this setup happens. So anyway, I guess I don't know if that answered your question, but I think maybe it did.
Do you think the government is secretly buying stocks to prop up the market going into the election?
I have no way to know that. I think they try to control anything and everything they can. I think they got their fingers on everything. Obviously, the Fed is, they're all about, they manipulate. Like I said, they created this entire last rate hiking cycle. And so could they be buying stocks to try to manipulate the market and hold it up? Who the hell knows? I don't know. Would it surprise me? No. Am I suspicious that they may be doing something like that? Yeah. The behavior coming out of that August low was suspicious. I've had subscribers call me and tell me they thought that the behavior was suspicious, and they're right. So I don't know, but eventually one or two things are going to happen. Either they're going to lose control or they're going to let it happen. And it's that simple. Either they're going to lose control with the manipulative efforts, or they're just going to let it happen.
We'll have more with Tim Cyclesman Wood right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, are you holding major equities right now, or have you already sold and are holding on for this crash you anticipate?
I think no. I'm not. I wouldn't want to be in the market in any way. I would not want any part of it. I think we're in a land, and we're in a minefield, and it's just a matter of it going kaboom. As far as guidance on this, like I said, I have guidance in looking at the structure, and when I see the structure, then I know we're at another juncture where it can take hold. And we're in the last inning of it. It's just a matter of, like I said, seeing the right structure again with equities, and then I think it's going to get interesting.
What's the story going to be with gold?
No one wants to hear this, but I'm going to say it. I have been bullish on gold because I had the cycle bottoms, and we had a long-term 9-year cycle low in 21. Gold it's been up, and I'm not denying that. I see it. You can't deny it. But the reason gold has done so well in the last, let's go all the way back to 2002. Gold bottomed in late 99 or 2000, I believe it was, at like 300 and some an ounce, $352 or something like that. No, may have been $252. And the reason gold has done so well is because they've been able to inflate and continue this inflationary effort, or reinflation effort throughout the years. And gold is obviously, like I said, done very well. But if you look at what happened in 07, and you look at what happened, even in 11, gold turned out to have a 9-year cycle top. Every time we move into these deflationary downturns, it affects gold, and gold tends to go down with those, with those deflationary cycles, if you will. So there's some things that I've written about with this advancing gold that are warnings, some major non-confirmations I'm seeing with gold, I cover in the letter, that are telling me that this is an ending move with gold. And here it all comes down to this. If they're not able, if this really is the downturn, if it bites, this next downturn out of this long-term economic cycle, if it bites for real, gold's going down with it. It's just it always has, and that's just the way it is. If they're able to save it again, then continue to inflate, then gold's going to be a beneficiary of that. And we will see continued higher gold prices. How do we know? Looking at the structure of gold, understanding the structure that we're looking at, which is something I do. But the problem is that I'm seeing these warning signs that this is an ending push with gold into the overall setup for this downturn out of this long-term economic cycle. So I'm right now, yeah, everything's okay. But I'm cautious about it when the downturn comes. And everybody thinks it's going to be a safe haven. I think it's going to be exactly the opposite because of the deflation.
What's the story going to be with crude?
The same. Mm-hmm. Crude commodities have already peaked. We saw, look what happened to crude oil in 2020 when we turned out of the deflation. It's what happened with crude oil in 2007, 2008. I mean, crude oil actually, before somebody calls me on it, crude oil, I understand, crude oil actually peaked in 2008. It was the last to peak with that push up. But as we rolled over and the deflationary pressures mounted, crude oil crashed in the deflationary pressures into the 2009 low, which, by the way, I called that 1 week after the top on another financial radio broadcast thing, kind of like yours at the time.
So the markets might be described as a moth headed towards a candle. The closer it gets to the candle, the faster it goes, but eventually it hits that candle and the wings come off.
Right, and we've been watching this. Jim, you and I have talked about this bubble for years since we've been talking, but here we are. Like I said, we've known. I've talked about the bubble, but I've also, in the interim, there's not been anything to hang your hat on. I mean, like I said, last year when the market peaked in 2023, I said no. We talked about it, said no, we're going higher, and we did. And then this last year when we rolled over into the April lows, I said no, we're going up. We're going up into the third quarter. So I mean, I'm not a perma bear in the sense that I've been standing in the way of these advances, but nothing has changed with this bubble. The bubble is what the bubble is, and it's been created on the back of what it's been created on, and it's a matter of getting to the setup for the next downturn, and that's where we are. We're in the ballpark now.
So, Tim, how would you wrap up what we've talked about today?
It's not as it appears. Nothing ever is as it appears. And, I don't know exactly when this top in equities is going to come now that it's proven to be another push up. I know what it's going to look like when the structure's in place for it to turn. And that is what I'm watching, and that is what I'm reporting on. And when that happens, we're going to be standing on the financial trap door. So once that happens, we just have to see see how it falls, how it plays out.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. He was speaking to us from Gulf Shores, Alabama. If you have any questions for Tim or for the show, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on X @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.